If you ask any professional investor what they're watching right now, they're probably gonna say small caps. And why wouldn't they? It's been the biggest market mover in the last 2 months. But what investors really should be looking at is bonds. Bond auctions are starting to see strong buyers come to town as the reality sets in that rate cuts will materialize sooner rather than later. So as the S&P 500 makes another 52-week high and approaches the elusive all-time high, is now the time to sell, hedge, or double down? Let's talk about it. Hello ladies and gentlemen, welcome to the Daily Recap Show. My name is Chase. We do these videos every single day, giving you the most concise and informative market recap. If you like this video, please subscribe, hit the notification bell. Let's get into it. Most of what we got throughout November and December is what we saw today. We saw breadth across stuff like financials, industrials, real estate, utilities, and the bigger names, Amazon, Google, Microsoft. To the downside, semiconductors continue to be extremely strong, and Apple was the weakest of the big names. On the Apple Watch news, there's some patent issues ongoing there, and it really does look to affect Apple's revenue, and we're going to see what that holds in 2024. Looking at the majors, the big winner was the IWM, the RSP as well, and also the S&P 500. It was just a bullish day across the board, but particularly in small caps, and I do think this is going to continue. I mean, small caps, 20% rally so far in the last 2 months, and they're still at like a 14.8 PE. And the current Christmas poll is running right now, guys. What is the next 100 points in the S&P 500 going to be? Go and cast your vote in the community tab on my YouTube channel. 53% of you are bullish, 47% of you guys are bearish, and I think a lot of people are looking at the Santa rally and saying, hey, we could move another 100 points in the S&P 500. The S&P 500 has had 8 consecutive up weeks. If you follow me on Twitter, you would have seen this already. And 8 consecutive up weeks normally leads to a fairly bullish action. 6 months on, an average gain of nearly 7% and 11% 12 months on. But there are risks. You see all this red right here. We normally do expect some form of a pullback in weeks 1, 2, and 1 month after. Normally we see those months or weeks as probably 50-50 positive, 50-50 negative. It really depends. It does get a little bit better 1 month on, but 6 months, 12 months on, it really does bode well for higher price action. And if we actually have a look at the charted version, you do see a bit of weakness right here before we do see pretty good gains in these 6 months or 26 weeks after 6% on average. Now let's take a look at the sectors and the best performing sectors: regional banks, semiconductors, energy. And you have to understand that a lot of the in small caps are filled with regional banks and a ton of small energy companies as well as mining companies, and they were the best performers. But holding it up in the large cap names was semiconductors. Every single sector was positive today. Even GDX, I mean, they came off the lows right here and finished 0.35% higher. A lot of people, if there were dips to be bought, they were being bought for the Santa rally. And breadth has starkly improved, guys. I mean, have a look at this. This is crazy. All but 2 sectors have almost 90% of stocks in uptrends. And this is percentage of sectors with more than 89% of stocks above their 50 moving day average. And that number is 80%. Very bullish stuff right here. And this is why I think breadth right now is so important. This is the year-to-date chart of the S&P 500, IWM, and the RSP. Just 2 months ago, 8 weeks ago, towards the end of October, start of November, the small caps and S&P 500 were sitting about -5%, probably closer to like -6, 6.5, 7%, whereas the S&P 500 plus 7%, okay? And so we saw very thin leadership in the biggest names and poor breadth in the smallest names. And I would be a mega bear if this didn't improve. Let's say we did have a rally from about the -7%, -6% range all the way to flat on the year, and we just consolidated right here. I would actually be bearish because this would mean something has to give. Either these have to go up or the bigger names have to come down. And if these were just consolidating right here, it was very obvious what's going to happen. But instead, what did we get? We got a broad rally in the big names, the small names, and the market as a whole. And this is why I'm bullish into 2024, despite possible headwinds that could come into the market. And we're going to talk about that in the video today. So another research firm joining the bullish train is Ned Davis Research, and these guys have nailed the last couple of years. In 2021, they were long for most of 2021. Then they trimmed their equity exposure in 2022. Then in 2023, they were about, on average, 65% long, and now they're moving their exposure to 70% long in 2024. And you know what's crazy about this? I think these guys watch my videos. About 2 to 3 weeks ago, I said I am 70% in equities and and about 30% in bonds, just under 30% because I hold a very small position in gold. That's what I was pretty much at, 70% equities, 30% bonds. And now these guys are copying me. These guys are watching my videos. I'm kidding though. But let's talk about why they possibly could be bullish. We got the PCE data on Friday, the Fed's preferred metric of inflation. On a 6-month annualized rate, it was at 1.9%, right? This is actually below the Fed's goal, or right at the Fed's goal. And if this continues for the next 6 months, we will actually get inflation just below 2% year over year. And many people thought that inflation was going to take a decade to fix and we weren't going to get to the Fed's goal until like late 2026. Apparently not. We could see it as early as 2024 April. Because if you have a look at what Goldman Sachs are predicting, a plausible path to get to the target inflation next year will involve profit margins fully normalizing and labor-reliant services prices not re-accelerating. If you get those two things, based on where core PC is right now, you get this figure right here. And as early as, end of April, May 2024, you could be at the Fed's target. But by the end of the year, most definitely at the 1.9% level. And further supporting this, we are actually seeing profit margins of consumer goods companies also suggest that price levels could normalize a bit further. And we're seeing price levels normalize from their peak after the COVID situation. And hopefully we could get to the 2017 or 2019 trend right there. That would actually be very good for the consumer and mute inflation as a whole. Now, we also got the latest MasterCard Pulse survey. And what we saw here was a 3.1% increase in total retail sales, 6.3% online, 2.2% in store. And the big driver was actually restaurants, up 7.8%. The actual estimate forecast for this was 3.7%. So this was a miss nonetheless. I was looking into this. I do think there's research that suggests that buy now, pay later is the reason why this number is at 3.1%. And it could actually be the 3.7% based on how much sales there were from the Thanksgiving period to now and the lagged ongoing payment structure of buy now, pay later products. What more can we expect from the consumer in 2024? Because at the end of the day, that 3.1% is still an increase. According to Goldman Sachs, we could see positive real wage gains, solid job gains, higher interest income, which could lead to disposable income growth of around 3% and consumption growth of around 2%. And we're seeing real wages adjusted for inflation next year, 1.3%, job gains of 0.9%, interest income of 1%, healthcare costs could increase a little bit, and there's other expenses right there. In other words, consumers are going to have more income while still spending more. That is super bullish. Now, all of these gains will be slowing in 2024, although still increasing year over year. Wage growth was at about 5 to 6%. It's now at about 4 to 4.5%. And the deacceleration could go to about 3.5%. That being said, it's still going to keep up with the 2% inflation, assuming we get there around April, May 2024. Furthermore, we could expect job gains to gradually slow, roughly at their break-even pace of about 100K per month, and the unemployment rate to stay stable at 3.6%, according to Goldman Sachs. So they should see employment at about 100,000 jobs increasing per month. They do expect the employment rate at about 3.6%. The consensus forecast, the recession forecast, is at about 4.4%, just under 4.5%. Now, let's actually talk about this. So I just gave you guys the bull case. Wage growth, employment, real income, and consumption will increase into 2024, although slowing compared to the year prior, according to Goldman Sachs. But what about a recession? Will we get a recession? Possibly. I mean, there's a couple of indicators saying that this could be the case. Housing starts rolling 12 months. When this tends to roll over, no pun intended, we normally do see a recession. And this is very, very accurate, except one time in 64. But the big one that bears need to look at is the LEI, the Conference Board US Leading Index. A bunch of indicators that are all summed up together. They're given a number. And normally when we get a deep contraction, like we do now in 2023, a recession normally comes. Now, it's not our job to predict what the market is going to do. It's our job to look at the data and react accordingly. Be prepared for the worst, but always err on the bullish side and have cash ready for deep market discounts. And when we do get a recession and the Fed cuts rates, it's normally pretty bad for stocks. Normally we could see peak drawdowns close to 20%, 10 to 12 months on. Very, very bearish stuff right here. But it does present great buying opportunities because recessions are becoming far fewer, which means there's less buying opportunities. And because of how governments are now super accommodative to people in recessions, fiscal and monetary policy is quite easy during recessions. We're seeing less recessions and more expansionary periods compared to 1940, where recessions were just like more common than not. But what I like to look at when it comes to recessions is these two indicators: total non-farms and disposable income. Now, we did have a bit of a blip here. This was COVID. This was injecting $5 trillion worth of money into the economy, but we're back on trend. Total non-farms are still where they are. And disposable income is still where it is. And until these turn over, I remain bullish on equities for 2024. And we also have to consider we are going into an election year, and fiscal policy has become more expansionary in election years. You can see here that all this graph is current revenues minus current expenditures. And normally in year 4 and year 8 of election years, we see this line, the average, fall. And essentially what it means is that there's just more current expenditures. The government is just spending more. There's more of a deficit, trying to win the vote of the people. And this happens in year 4 and year 8 of a presidential election. I gave you the bull case. I gave you the bear case. I'm bullish into 2024. My end of year price target is 5,100. But enough talk about next year. Let's talk about this week. And this is the Grinch parameter, something we've been following the first 3 days before Christmas and 3 days after Christmas. Normally a negative Grinch coincides with a positive January and a positive year. 18 positive years from 19. The only negative year was in 1968 of 11.4% with a negative Grinch. And the reason why we want this negative is because a positive Grinch has coincided with every single double-digit down year in the S&P 500 except one in 1969. And it seems the 60s was the only outlier in this data. And we are marginally positive for the Grinch, but it could be swinging in our favor, because if we actually have a look at the Santa rally, we are positive for the Santa rally. Day 3, day 4, and day 5 tend to be quite not bearish, but more negative than not. Look at all this red right here. And you can also see that the win ratio for these 3 days is 47%, 40%, 47%. And if we get a negative Grinch, positive Santa Claus rally, because day 1 and day 2 of the new year tend to be very positive and make up for pretty much the loss on all 7 days. If we get a negative Grinch and a positive Santa Claus rally, that is your risk on signal. And this is where we are right now. And the reason why these last 3 days of the year in the Santa Claus rally are negative has to do with equity allocation by pension funds and rebalancing. Normally these funds have to rebalance their portfolio to their target allocation of 0. And this is where we are right now, the annual allocation, the quarterly allocation, and the monthly allocation. And there's going to be quite a bit of selling over the next couple of days to rebalance their portfolio. And this money normally goes back into equities on the first trading day of the new year. And that's why the first trading day of the new year tends to be very, very positive. Now, last week's dip buyers were the real winners. For those of you that bought the dip right here, congratulations. For those of you that bought right here, you are now also in the green. Okay, we are marginally higher than last week's 0 DTE sell-off, and it's been a very good month of November. We're close to 4.5% gain after an 8% November. Very, very crazy. And looking at the gamma heat map, above 4,800, all of this right here, a lot of positive gamma. Below 4,710, a lot of positive gamma. And we're neutral gamma in this area right here, which probably means this is where we're going to drift for the rest of the year. There are a little bit of negative gamma pockets right here, but all in all, it's a gamma neutral zone. And this means that price can really do anything in this area, but strong support should come right here and strong selling should come right here. In positive gamma, dealers buy dips, sell rips. Let's have a look at some charts, guys. The S&P 500, bullish, super bullish. This chart looks bullish year over year. We're probably going to go higher. And I think we want to go get the 4808 level. That's actually been my exact target since this low right here when I told you guys to buy. Since the 4125 level, I said we're going to 4808. It's been quite the rally. Now, equal weight is doing exactly what the equal weight should be doing, and that's consolidating above the 155 area right here. If it keeps doing this, you can look to higher price action, potentially 160, then much higher from there. Looking at TLT, this kind of looks like it sort of wants to roll over, maybe find support right here at the 200-day moving average, and then go higher, but it is building a base and some of this overbought RSI is being worked off. So it is, in a sense, good. And as long as we stay above the 200 moving average, I am bullish on bonds to 2024. Now, looking at mid caps are doing what they should be doing, and that's they've broken above here. Last week, they closed above this trend line, and we are looking to go higher into 2024. And this is very, very bullish. If we can close above this level here this week, we can look for this level, a close. We can look for this high in 2024. Now, Russell, very much the same thing, although it looks a lot stronger than mid caps. We had a 1.3% positive day for the Russell right here, the IWM. and it's looking like it's going to go to 212. That's actually been my target, and I gave you guys the buy right here at 167. I said buy the Russell on my Twitter, and we're going to 212, and I think that's where we're going to go. That's where we're going to find some of the strongest resistance in the Russell. Tesla, people want to break out. I don't think we're getting it. I really think Tesla's just going to do this around the 250 level for the rest of the year. People want to see 300. I don't think we're getting 300 in Tesla, just my personal opinion. Regional banks is doing what it should be doing, and that's consolidate. And it just needs to keep consolidating, keep building a base, keep building volume, and stay above the 200 moving average. Looking at semiconductors, very, very strong, and they're sort of breaking out above this cup and handle. This was sort of like the handle right here. It's broken above, it's looking very strong. I do see an overall price target of 235 for semiconductors in 2024. Don't fight the trend right here, guys. Don't try and short this. Don't be a hero. Momentum brings momentum. Mining and metals. This is what the Tesla chart should look like. Tesla is sort of just doing this. What Tesla should be doing is breaking above key levels if it wants to go higher. That's exactly what metals and mine, this is the XME, is doing. They're breaking above key levels right here, and now they can go ahead and look to this price target of $68. So all in all, bullish, and not even that overbought. I think we're probably going to go ahead and hit the 68 level sooner rather than later. As early January, in my personal opinion. Metals looks very, very strong. Energy, not quite as strong as metals, but it has broken above the 200 moving average right here. And what it needs to do is stay above here and build out a base of volume and look to higher price action. But I'm not fully bullish on energy at the moment. It needs to work some more. Looking at the dollar, it has come down, and this has helped energy prices. And hopefully we continue to see a weaker dollar throughout 2024, just to help companies in the S&P 500. 40% of S&P 500 revenues come from overseas, and a weaker dollar means more profits as a whole on their sheets. It literally means like 1 to 2% extra revenue on a current cash basis. And I do think we should find support around this 99.50 level, and then we'll see what the market wants to do. But it does look like it's going lower, especially because of the fact it rejected the 200 moving day right there. And looking at data in the week ahead, there's not much data, guys. The big one is initial jobless claims. A very, very light week of data, not much to go by. But if you've made it up until here, guys, thank you so much. If you like this video, please subscribe, leave a like, hit the notification bell, guys. Leave a comment. Cheers.